All right, today we're taking a close look at the Q2 2025 earnings for Highwoods Properties. That's ticker HIW. And this is a really interesting one. It's a classic case of a company that, on the surface, looks like it's doing everything right, but the market just isn't buying it. So let's get right to the heart of it. Highwoods beat the street on funds from operations. That's their key profit metric. And not only that, they raised their guidance for the whole year for the second time. Now, normally, you'd expect the stock to pop on that news. But instead, it fell over 4%. So the big question we're going to unpack here is, what did Wall Street see that the headlines completely missed? Okay, so first up, let's just lay out the good news. Let's look at the numbers that had the management team sounding so confident on their call. Because on paper, this was a clear win. They delivered funds from operations, or FFO, of 89 cents per share. Remember, for a real estate investment trust like Highwoods, FFO is the number that really matters. And look, this wasn't just a squeaker of a beat. That 89 cents was a full 4.7% higher than what the analysts were predicting. That is a very, very solid beat. So what was driving this? Well, it was some serious leasing momentum. Highwoods signed leases for almost 1 million square feet of office space. 923,000 to be exact. And in this environment for office space, that kind of volume really shows there's legitimate demand for what they're offering. And if we look at the whole scorecard, you see that strong FFO beat right there at the top. But here's our first clue as to why the market might have been a little spooked. See that revenue line? It was a tiny miss against what was expected, but here's the kicker. It was actually down 2% from this time last year. But even with that little dip in revenue, management clearly wasn't worried. They felt confident enough to raise their FFO guidance for the entire year. That's a huge signal that they believe the underlying strength in their operations is more than enough to make up for any softness on the top line. So you've got an FFO beat, you've got a guidance raise, which brings us right back to the central mystery here. Why on earth did the market hit the sell button? This slide really tells the whole story. It's like two groups of people were looking at the exact same report and seeing two completely different things. Management was talking up all their operational wins, the FFO beat, the killer leasing numbers, their prime locations in the Sunbelt. But the market? It seems like they just zoomed in on the negatives, that year-over-year revenue decline we just talked about, and a debt-to-EBITDA ratio of 6.3x. In a shaky economy, investors get laser-focused on top-line growth and clean balance sheets, and sometimes that's all they see. But see, that's just the short-term reaction. Management is basically arguing that the market is missing the forest for the trees. They're saying there's this powerful long-term growth engine that's already built right into the company. And this engine, it's got 4 main parts. First, keep selling off weaker assets and doubling down on the best submarkets in the Sun Belt, what they call best business districts. Second, finish stabilizing 4 huge key assets that they call the Core 4. Third, get their new development projects finished and leased up. And finally, just sit back and benefit from a shrinking supply of high-quality office space. Now, a plan is just a plan without execution, right? Well, when it comes to those Core 4 properties, which have a potential upside of $25 million in future income, the CEO, Ted Klink, came right out and said that half of that upside is already locked in. It's done. The leases are signed. That's not a guess. It's a fact. And it gets better. When you add the potential from those Core 4 properties to the income from their new developments, you're looking at a total annual net operating income growth of over $55 million. And here's the most important part. This isn't some pie-in-the-sky forecast. Over 60% of that $55 million is already secured by signed leases. I want to repeat that. That's more than $33 million in future annual income that is contractually obligated to hit their books. That growth is already baked in. And all of this is happening while the overall supply of office space is actually shrinking. In 2025, we're looking at 23 million square feet of old office space getting torn down or converted, while only 13 million square feet of new stuff is getting built. This slow squeeze, as they call it, just gives landlords of premium buildings like Highwoods way more pricing power. Okay, so let's put it all together. You have a solid quarter, a really skeptical market, and what looks like a very clear, de-risked path to future growth. So, what's our take ahead of their next earnings call? So here's what we're looking for. We expect FFO to stay pretty stable next quarter. mainly because they're spending money now to build out those spaces for all the new tenants they've signed. But the key metric to watch, the one that really matters, is occupancy. That should finally start taking up as those new tenants move in. And as that happens, we think the stock price will have to start catching up to the company's real value. Yeah, because of this really clear disconnect between the current share price and the visible, already locked-in growth that's coming, we're giving this an outperform rating. So how might you think about this from a trading perspective? Well, our first idea is what we're calling the leased to owned discount. Right now, there's a 330 basis point gap between Highwoods' leased rate and its actual occupied rate. That's double the historical average. The idea here is to go long, betting that as this gap closes over the next year, all that potential from signed leases turns into actual cash flow on the books, forcing the market to sit up and take notice. Our second idea is the Sunbelt squeeze play. See, Highwoods is a pure play on the best office markets in the country, period. So to isolate that specific advantage, you could go long HIW while at the same time shorting a diversified office REIT ETF, one that's bogged down by exposure to weaker, older markets. This is basically a bet on the Sunbelt itself continuing to outperform everyone else. Now, before we wrap up, just a quick reminder. This content is for informational purposes only and is absolutely not financial advice. So we'll be watching this one very closely, with one question in mind. Will the market finally wake up and start pricing in Highwoods' already secured growth? Or will those broader economic fears continue to keep this Sunbelt story on sale? We'll see.